Good morning and welcome to the Vivid Seats third quarter 2025 earnings conference call. Following management prepared remarks, we will open the call for Q&A. I would now like to turn the call over to Kate Africk.
Good morning and welcome to Vivid Seats third quarter 2025 earnings conference call. I am Kate Africk, Head of Investor Relations at Vivid Seats. This morning we issued our third quarter financial results. The press release, as well as supplemental earnings slides, are available on the Investor Relations page of our website at investors.vividseats.com. During the course of today's call, we may make forward-looking statements within the meaning of federal securities laws. These forward-looking statements are subject to risks and uncertainties that could cause actual results to differ materially, including the risks and uncertainties described in our earnings press release, our most recent annual report on Form 10-K, our subsequent quarterly reports on Form 10-Q, and our other filings with the SEC. On today's call, we will refer to Adjusted EBITDA, which is a non-GAAP financial measure that provides useful information for investors. A reconciliation of this non-GAAP financial measure to its corresponding GAAP measure can be found in our earnings press release and supplemental earnings slides. This morning, we also announced a leadership transition that is effective today. Lawrence Fey, who has served as Chief Financial Officer since 2020, will succeed Stan Chia as Chief Executive Officer. Additionally, Ted Pickus, who has served as Chief Accounting Officer since 2022, has been appointed as Interim Chief Financial Officer until a successor is identified. Accordingly, Larry and Ted are joining me today on the call. With Larry's extensive history with Vivid Seats dating back to 2017, the Vivid Seats board believes he is uniquely qualified to navigate the evolving industry environment and steer the company back to growth. Larry will share more detail on his vision for Vivid Seats' next chapter today. And now, I would like to turn the call over to Larry.
Good morning, everyone, and thank you for joining us today. First, I would like to discuss the leadership transition and express my gratitude to Stan for his leadership and service over the last 7 years. His accomplishments include successfully leading Vivid Seats through a global pandemic, bringing Vivid Seats to the public markets, and launching key innovations such as the Vivid Seats Reward Program, which provides a foundation on which we will continue to build as we deliver a unique and leading value proposition to our customers. I recognize the responsibility of this role and will look to take decisive action to reverse recent trends and build a resilient business well-positioned for long-term success. The core pillars of our strategy start with the foundational advantages that have been in place at Vivid Seats for years and build from there. There is much work to be done, but the foundation to return to profitable growth is in place, and our path forward is clear. Vivid Seats has long been known for its leading tech capabilities, unique data, and focus on efficiency. In recent years, as paid search has become more competitive and customer acquisition economics have become strained, Vivid Seats has increasingly invested in its app with a focus on building a loyal and recurring customer base. We are now increasing our focus and investment in delivering a leading value proposition to our customers. Alongside our loyalty program, with rewards redeemable in the app, late in the third quarter we launched our lowest price guarantee, also in the app. We believe the combination of our lowest price guarantee and our loyalty program represents the most compelling value proposition in the industry, and we are already seeing positive responses from our customers. With our enhanced value proposition, we expect to see a growing number of app users and resulting transactions. Our app users return more often, convert at a higher rate, and touch performance marketing channels less. Over time, as our volume increasingly moves into the app, our performance will be increasingly insulated from the heightened competitiveness we have seen in performance marketing channels in recent years. Further, we believe that information transparency will only increase as AI proliferates and impacts the way consumers interact with brands across the internet. It will take time to build comprehensive awareness of our enhanced app value proposition, but we are confident we will disproportionately benefit as AI reshapes consumer discovery and decision-making as we match consumer demand with the most compelling value in the industry. One of our initial efforts to build awareness of our app value proposition is our recently renewed partnership with ESPN. With ESPN, we have launched a national marketing campaign on Disney streaming, which is reaching more than 127 million global subscribers across over 700 live sports events monthly. We are excited to see how fans respond to our new offering as awareness continues to build. We believe our investments in delivering a leading value proposition will drive order volume but reduce our take rates. Funding these investments in a sustainable manner will require a commitment to operating the most efficient platform in ticketing. We will focus on operating as a lean and agile organization enabled by powerful technology and unique data. We announced the cost reduction program last quarter, and we are now more than doubling our fixed cost reduction target from $25 million to $60 million. We have made substantial progress towards our updated target with savings spanning fixed marketing, G&A, and stock-based compensation. Both these savings and our considerable reinvestment in our app value proposition are reflected in our initial 2026 guidance. Continuing with our theme of driving efficiency through clear focus, we executed our corporate simplification agreement, which included the termination of our tax receivable agreement and the collapse of our dual-class share structure early in the fourth quarter. The corporate simplification will yield substantial immediate and ongoing savings. As part of the termination, we issued approximately 400,000 Class A shares to the former TRA parties. In return, we will avoid $6 million of cash TRA payments otherwise due in Q1 2026, while capturing up to $180 million of lifetime tax savings, subject to generating sufficient profitability. In addition, by simplifying our structure, we expect to save approximately $1 million per year from reduced financial reporting and compliance costs, while also removing tax inefficiencies in our structure. At current levels of profitability, we anticipate our annual cash income taxes to be approximately $3 million. The savings between our cost reduction program and corporate simplification will create a more focused and agile organization, one that can invest strategically for growth while maintaining discipline and profitability. Next, I'll address trends in our third quarter results, which we believe validate our path forward and underpin our initial 2026 outlook, which Ted will provide. While private label remains under pressure, we are encouraged to see stabilization and early signs of momentum across our owned properties. Against a flat sequential industry backdrop, Vivid Seats and Vegas.com delivered sequential GOV growth, while the Vivid Seats app delivered double-digit sequential growth and returned to year-over-year GOV growth. This is a direct result of our ongoing investment in product development and our enhanced value proposition. As we look to the fourth quarter and into 2026, there are no quick fixes, but our priorities are clear. We are committed to improving our financial performance by leveraging Vivid Seats' foundational advantages, including leading technology, unique data, best-in-class efficiency, and continued investment into a unique and differentiated value proposition. Now I'll turn it to Ted to discuss the quarter and financial outlook in more detail. As we mentioned earlier, Ted, our Chief Accounting Officer, will take on the role of Interim Chief Financial Officer. Ted has been at Vivid Seats leading our accounting function for more than a decade. I have full confidence in Ted, and I'm glad to have him step into the interim CFO role as we manage our leadership transition.
Thank you, Larry, and hello, everyone. I am honored to be with you today and to assume this role during a transformational time for the business. Turning to our results, in the third quarter, we delivered $618 million of marketplace GOV, $136 million of revenues, and $5 million of adjusted EBITDA. These results reflect an intense competitive environment that impacted our private label business, which was also impacted by the loss of a large partner. We generated $618 million of marketplace GOV in Q3, which was down 29% year over year. Total marketplace orders were also down 29%, with average order size flat. Looking at sequential trends compared to Q2 of this year, overall marketplace GOV was down 10% due to private label headwinds, while owned property GOV increased in a flat sequential industry environment. We generated $136 million of revenues in Q3, down 27% year over year. Our Q3 marketplace take rate was 17.0%, down from 17.5% in Q3 2024. We expect near-term take rates in the 16% range. Our third quarter adjusted EBITDA was $5 million, down substantially from the prior year due to lower volume, lower take rates, and negative operating leverage. We expect improved operating performance as we enter 2026 with the full benefit of our recent cost reductions. Next, I'll address our 2026 initial outlook. With stabilizing owned property volumes, we expect 2026 marketplace GOV in the range of $2.2 to $2.6 billion. At the midpoint, this assumes marketplace GOV roughly in line with our third quarter run rate. We intend to reinvest cost savings into our enhanced customer value proposition and, as such, currently anticipate $30 to $40 million of 2026 adjusted EBITDA. Our 2026 initial outlook assumes industry volumes are flat year over year as the core concert on-sale season, which provides supply visibility for the coming year, has yet to occur. We ended Q3 with $391 million of debt, $145 million of cash, and net debt of $246 million. Against a flat industry environment, we saw working capital continue to consume cash, but at a substantially lower level than seen the first half of the year. I'll now hand it back to Larry for concluding remarks.
Thanks, Ted. Despite challenging year-over-year trends, the third quarter offered signs of stabilization, including sequential growth in owned property GOV, year-over-year growth in app GOV, and substantial cost reduction progress. From here, diligent execution is crucial, but we believe our investment into our app value proposition provides a clear path to return to growth. With that, operator, let's open it up for questions.
Thank you. As a reminder, to ask a question, you will need to press star, then the number 1 on your telephone keypad. And if you would like to withdraw your question, press star 1 again. We do request for today's session that you please limit to 2 questions only. We will pause for just a moment to compile the Q&A roster. Your first question comes from the line of Cameron Mansson-Perrone with Morgan Stanley. Your line is open.
Thanks, morning. Thanks for taking the questions. And Ted, welcome to the call. I guess the first question is really just, I'd like to hear a little bit more about what gives you confidence in issuing 26 guidance this early, given the pressures that have existed in the business recently. I heard you on the stabilization front, but just, a little bit more on what gives you kind of that increased visibility relative to the past, I think would be helpful. And then if you could just kind of try and help contextualize what's reflected in the high and low end of the guide for next year with regard to, competitive environment and expectations and any other gating factors around, what would determine, whether you shake out on the high or low end. Thanks.
Yeah, thanks, Cameron. I think you've heard us say in the past that we prefer to give guidance on our Q4 call once the Q4 on-sale calendar has run its course, as you'll have more industry visibility. And so the important caveat in the guidance we put forward is it presumes a flat year-over-year industry outlook. And I think to your question on what would govern the low end versus the high end, I would start with if the industry under indexes to flat, that would push you towards the low end. If it over indexes or grows, that would push you towards the higher end. We certainly saw the Live Nation commentary, which if you interpolate what they said, it feels like they're pointing towards another positive growth year in North America. So hopefully there's some conservatism built in. We'll learn more over the coming months on exactly where the industry settles out, but try to put a baseline that we think is reasonably skewed to the cautious side of the spectrum on the industry performance. Why do we put guidance out? Why do we have confidence? I'd point to a few elements. I think one, we obviously pulled 2025 2025 guidance, so it's been a while since there's been a flag or a stake in the ground for folks to look at. You can see a number of changes playing out in Q3 where we talked about our cost reduction initiatives. We talked about some of our reinvestment in our value proposition and lots of puts and takes. And rather than having there be a vacuum where people were waiting in suspense for 4 months on what the net of all of those are, we wanted to distill it down to a target. Probably goes without saying, if competition or competitive intensity reaches new highs, that will pressure, and if they abate, that will be a release valve relative to the range we put forward. But we've assumed essentially a broad continuation of the competitive intensity we've seen in the second half of 2025.
Got it. That's all clear and helpful. Thanks, Larry.
Thank you.
Next question comes from the line of Dan Kurnos with Benchmark Company. Your line is open.
Yeah, thanks. Good morning. Larry, I guess maybe just to double click on the leadership transition. Obviously, Dan had a lot of digital experience from his history. So I guess maybe why now make this move? If you could just give us some color on the thought process. And obviously, to be clear here, I think you're eminently qualified to lead the company, Larry. I just, would be helpful to get sort of some of the thought process on the timing. And then, in an agentic world, you talked about discovery with OpenAI. If you're going to push apps, which is fine, everyone else is putting their app into OpenAI for discoverability. So, I don't know what your thoughts are about that, given some of the puts and takes on demand gen and OpenAI potentially becoming the source of demand gen, but just help us think about your willingness to increase visibility via that channel and other ways that you might increase the visibility of the value prop. Thank you.
Yeah, thanks, Dan. I'd start with it. The thanks to Stan, of course, we're sincere. 7 years was a great run. I think it was just reaching a time for a shift, and preparing the business for the efficiency push that we're embarking on in the near term. To the second question, I think you touched on a theme that is spot on. Yes, we're pushing on app, and I almost think of the customer universe as two buckets, right? There's the new customer acquisition, and there's a competitive dynamic around that, and then there's the folks who have already done their research and made informed decisions around which marketplaces they buy from or which marketplaces they consider, and that generally occurs in the app. Where I think there could be a really interesting blurring of those lines or fusion of the two as we move forward. If one of the fundamental tenets of AI is increasing information synthesis, increasing information transparency, as we increasingly place the best value proposition out into the ether, we then, of course, have an obligation to make sure that value proposition is digestible by these new AI platforms that are looking for all of the best information to synthesize and distill for customers. But you better have something that's compelling, right? If they do their job and put forward the best value proposition, you better be front of the line. And so that's where we're going with the app. I think in the near term, while we wait for the commerce portion of the AI disruption to fully arrive, we're going to continue focusing on retaining our customers in the app ecosystem. And then we think there's opportunity coming on that customer acquisition as the technology format evolves.
Great. Thanks, Larry. Appreciate the color.
Next question comes from the line of Maria Ripps with Canaccord Genuity. Your line is open.
Great. Good morning, and thanks for taking my questions. And Larry and Ted, congrats on the transition. Can you maybe share a little bit more color on the competitive backdrop right now? Are you seeing any early signs that maybe some of the competitors in the space are starting to focus more on profitability?
Yeah, thanks, Maria. We've talked in the past a bit about ebbs and flows, and it can be a little dangerous to extrapolate short-term behavior and assume it continues indefinitely. But I would say, broadly aligning with call it changes in corporate status, we have seen a shift in competitive posture. It was a fairly methodical increase in share that we saw from StubHub over the last couple of years. It would come in waves, but it kind of went one direction, and we've actually seen that reverse and roll over in September and October, where they're now down year over year on share, and I think that is directly tied to what we perceive as a shift in marketing aggressiveness. The magnitude obviously was enough to reverse that trend, but it wasn't, like a reversion to 2022 or 2023 levels. And we, of course, know that they reserve the right to change their mind and posture as we embark into 2026. But a notable change over the last, call it 6 to 8 weeks.
Got it. That's very helpful. And then any early thoughts you can share sort of on quality of concert lineup in 2026?
Yeah, I'd say continue to be looking to Live Nation for the prospective views on what's coming. I heard pretty positive commentary when I read the release. I think they touched on what clearly looks like positive North American growth, a skew towards larger venues. Thus far in the year, you get into these year-over-year comparisons where timing just varies slightly year-over-year. But we're in the midst this year. Morgan Wallen just announced that I think will be one of the top tours of the year. We've seen several others. So at this point, I would say, other than week-to-week variance, it looks like the Live Nation commentary is flowing through in what we're seeing.
Got it. That's very helpful. Thank you so much.
Thank you.
Next question comes from the line of Ryan Sigdahl with Craig-Hallum. Your line is open.
Hey, good morning, Larry, Ted. In response to the FTC lawsuit, Ticketmaster is shutting down Trade Desk for concerts. They're also limiting Ticketmaster accounts even further, as it appears, as they take more action on pricing. Curious your perspective on this. Does this present an opportunity for Vivid to take share on the POS side? But at the same time, I guess the negative would be, how much contraction and negative do you see from a supply standpoint in the secondary ticketing?
Yeah, thanks, Ryan. I think you framed it properly in that any disruption to Trade Desk, I think, can only be a tailwind, and we think Skybox will be waiting with open arms with its best-in-class capabilities to support any customers who no longer have the full suite that they need to run their business, and can only help our position. And then, as you said, counterbalance if there is additional pressure. I'd start from our fundamental view is that the vast majority of what drives this industry is a fundamental well-functioning financial market, right, where you have artists and teams who are looking to diversify risk. You have artists and teams who are looking to offload risk well in advance of shows, and that there is a healthy, vibrant financial instrument via the secondary market that facilitates and benefits all parties. To the extent folks are violating the rules of the game, we have always said this, we continue to say it, we can, should, will support anything and everything that needs to be done to ensure folks do play by the proper rules as defined by the artists and the primary ticketing platforms. To the extent there are folks that are, I'm sure there are, right? There's got to be a bad actor out there. To the extent those folks' behaviors are forced to modify, I think what will be unknown, right, and we'll find out as you all find out, does that contract the secondary market, or does it just change the form where you now have increased fragmentation, where new smaller sellers fill in the gap and the overall market opportunity remains the same. So we'll keep a close eye on it, but I do think there's a positive tailwind on Trade Desk, a potential headwind, but maybe not on the change to Ticketmaster policies.
Thanks, Larry. Then just the other hot topic, kind of from an industry standpoint, direct issuance. Vivid has a smaller DI type offering with college basketball Crown, but curious what you think about the ambitions of some of your peers in the space on this model specifically, and then kind of to your point on rules of the game, I guess contractually, et cetera. I guess just your thoughts on direct issuance and the viability of doing that in an accelerated way going forward, and what that potentially means from a secondary marketplace standpoint, if that further limits the supply of brokers play.
Yeah, I think obviously strategies are subject to change, and so just reacting to the way we have seen the direct issuance opportunity defined to date, and maybe they change this, but to date it's been primarily focused, as we understand it, on unsold inventory. And so you can imagine, regular season baseball games, less popular theater shows, where you have, well past the event going on sale, substantial available inventory available from the primary. And if that gets piped directly into a secondary marketplace, that would represent incremental supply. I think the threshold question for the robustness of that opportunity would start with, is this a supply or demand constrained industry? And does the fact that you took an event that already had a decent amount of supply and made more available, will that stimulate incremental demand, or will it cannibalize the eyeballs that you were already getting on the site, and to sell more you still need to get additional eyeballs and spend the marketing dollars to bring them in? I think our viewpoint has been that generally this is a demand constrained exercise, not supply constrained, in all but the most rarefied air. Right, like you could see Taylor Swift tickets really selling out, but most events, including World Series, Super Bowl, right, there are tickets available all the way up until the event starts, even for the highest profile events. So I'd say we're a bit more muted on our belief of the impact that could have, but we certainly have heard that the ambitions are big, and so we'll keep a close eye.
Thanks, Larry. Good luck, guys.
Next question comes from the line of Ralph Schackart with William Blair. Your line is open.
Good morning. Thanks for taking the question. Larry, I just kind of want to circle back on the sort of driving more awareness to the app and sort of the efforts there. I know you talked about having ESPN as a partner to do that, which obviously a great partner to have there. But maybe you could just sort of provide a little bit more color how you drive more direct traffic here and build more awareness. And would you be contemplating, potentially like a marketing campaign or other efforts to grow more awareness to go direct to that? Thank you.
Yeah, thanks, Ralph. I think we're doing what I would call our brand marketing surge via ESPN. That is going to be concentrated in the near term, kind of throughout Q4, which is peak sports season. I think this is an industry where there's been many attempts to do broad-based brand marketing, and it is challenging to prove compelling ROI from that. So I don't think we're going to, reverse course and jump headfirst back into broad brand marketing. I think we're going to continue to focus on thoughtful, different slices of, call it more targeted performance-based metrics. One of the advantages we have, foundational strengths we have, is we've been one of the leading marketplaces for a long time, and as a result, we sold a lot of tickets to a lot of people, and we have a really robust existing user base, really robust CRM database, and so a lot of our effort has been increasing our personalization, improving the nature of our messaging, and now when we're delivering a message with a fundamentally improved value proposition, I think that leads to more engagement across that existing user base. And then continuing as people, we acquire them on the web, making them immediately aware of what awaits. If they trusted us enough to buy on the web, that's wonderful. And we have perks that would compel them to come back to the app, and making sure that hyper addressable audience gets made fully aware of the proposition. Those are the two major buckets I think we'll be focusing on in the near term.
Okay, great. Thanks, Larry.
Next question comes from the line of Stephen McDermott with Bank of America. Your line is open.
Hey, good morning, and thank you for taking my question. Just two quick ones. Firstly, for 2026, what World Cup assumptions are kind of built into that outlook?
Yeah, we essentially have not assumed a meaningful impact from World Cup. I think that is primarily due to two things. One, there's not a lot of precedent that we can rely on, right? The U.S. World Cup in an era with online secondary ticketing has zero precedent data points. When we look at the last two World Cups, they were in markets that we basically don't operate in Russia and Qatar. And so trying to strike a cautious tone given a lack of conviction beyond that. The second observation, I think it's fairly well documented, but we've seen, FIFA be, let's say, quite aggressive in seeking to optimize their monetization of the event. I think it's safe to assume there will be incremental volume. We will benefit from it. But between those two factors, we've opted to essentially disregard it as we've contemplated our outlook for next year, and it would purely represent upside.
Got it. Thank you. Appreciate that color. And then my second question, it sounds like you said StubHub pulled back on marketing spend a bit. Is it fair to say that the Q3 exit rate improved on a year-over-year basis?
Yeah, I think it would be fair to say that over the course of Q3, we saw a shift in their behavior and a corresponding shift in volumes across marketplaces. Yeah, that happened closer to the end of Q3 than the beginning.
Gotcha. No, that's very helpful. Thank you.
Next question comes from the line of Brad Erickson with RBC Capital Markets. Your line is open.
Hey, thanks. I just follow up on that last one, actually, Larry. When you say, when you look at kind of what's instructing the stabilization commentary on the owned property business, so you mentioned competitive intensity easing several times. Is that kind of the main driver? Any other drivers you'd call out there, either things in your control or other market forces?
Yeah, I think that the biggest one is, so the competitive landscape, of course, matters. But I'd say of similar, if not equal, if not slightly more importance in terms of what we've seen in the immediate term has been this value proposition push. And inherent in what we're trying to achieve, as we get more volume in our app, I think that is a more protected ecosystem, right? You can bid whatever you want for a Google link, but if someone already has our app, already trusts us, is already looking at us, they will likely look at us, and if we have a structurally better offer, it doesn't matter who else is buying the top Google link. And so you control your own destiny more on app. That's why we're pushing, right? Reduce the surface area and exposure to competitive response. That's a long game play, right? You don't make that change and immediately have, profound shift of volume from one channel to the other. But we have seen market increases in the volume that's moving into the app. And I think this is one of those like layer cake dynamics where every month that goes where you bring in a new cohort of customers who have done their research, seen the value prop, they're going to be fundamentally stickier. And over time, that will compound and build into something pretty exciting.
Got it. And then appreciate the 26 guide and all you gave the EBITDA numbers. Any color you can give maybe on cash conversion relative to that EBITDA guide? Thanks.
Yeah, so appreciate that question. Yeah, I think if we look at our cash obligations moving forward, have roughly $20 million of net interest expense. We'll have a bit less than $20 million of cap software. And then we mentioned in this release that pro forma for the TRA transaction will have about $3 million of cash taxes, primarily from international operations. So you sum those up, before you consider working capital, you have a roughly $40 million set of cash obligations. As we've talked about quite a bit the last few quarters, when we're growing, working capital is a source. When we're shrinking, it's a use of cash. And so I think at At the center of will cash balance grow next year is, do you believe that we can sequentially grow GOV? I think it's reasonable to assume that, take Q1 as we lap the private label losses that we saw in Q3, continue to lap those. The overall year-over-year GOV numbers will continue to be down. But if the sequential health, because the balance sheet kind of remarks to market every quarter, is stable and growing, you can see working capital reverse course. And so the base case plan is at the midpoint or better of our guidance. We would expect to be cash generative next year.
Understood. Thanks.
Next question comes from the line of Ben Black with Deutsche Bank. Your line is open.
Hi, thanks for taking the question. This is Kunal for Ben. Quick one on the outlook, and you just talked about the cash flow consequences that we could see. One thing with regard to the assumption that underlie that, so are you assuming that the competitive intensity remains at the September-October levels in 2026? Or are you assuming that maybe things go back to what we had seen earlier in this year? And that is what determines the market share that you expect in 26. And then the second one would be with regard to the traffic that you are getting and the traffic that you have on your app. What is different from other providers that makes your value proposition so unique that people will not go anywhere else to shop? Thank you.
Yeah, so let me start with the app value prop, because I think that's a really compelling one. I think we've talked about our loyalty program for a number of years. We continue to be on a journey to build awareness of that loyalty program, but those who find and use that program, I think structurally buy more at a multiple of the typical user. And it, even before the more recent changes to our value proposition, I think resulted in kind of a clear best-in-class value prop. And then, recently what we've really pushed is, base lower everyday pricing. And then we're continually innovating on what kind of inducements and incentives we can provide as customers move through their journey, their lifetime journey with us. So we think if you create an experience where someone comes in and realizes that you're pricing without paying consideration to any incentives, without paying consideration to loyalty, are the best in the industry relative to our largest competitors. You have a good experience, right? You get great customer service, you enjoy the layout of the site, and then subsequent to that, you get thoughtful recommendations, you get incentives and inducements, you sign up for loyalty, and that price advantage becomes even more significant. That's a really compelling lifetime experience. Now, is that to say that others, can't offer various elements of that? I don't think there's anything philosophically that would prevent folks from doing it. I think it's an economic question, right? If you're spending significant amounts bidding for the top keywords on search, can you do that and offer these lower price points? If you have, very large partnership obligations, can you do those and offer these inducements and incentives? So we'll see, right? I think our belief is that we can operate the leanest platform, and that uniquely enables us to sustainably deliver a best-in-class value prop. And others will need to respond as they see fit. As it relates to the first question on the competitive environment contemplated, it's difficult to be precise on this. We certainly have seen that it's been kind of an up and to the right level of intensity over the last 2 years, and we want to make sure we don't just forget that. We also want to reflect that we have seen a change, and so I would characterize the midpoint as call it something in between what we've seen September and October and what we saw as the worst of it, kind of late Q1, early Q2. And so a little bit of reversion from the run rate, but not all the way back to the most extreme point that we saw.
Thank you.
Next question comes from the line of Thomas Forte with Maxim Group. Your line is open.
Great, thank you. So first off, congratulations, Larry and Ted, on the new opportunities, and best wishes to Stan for his future endeavors. One question, one follow-up. So Larry, are you seeing any changes in consumer behavior when it comes to the secondary ticket market? For example, when you have a Game 7 in a playoff series, are they still willing to pay premium prices for the experience as they have in the past?
Yeah, thanks, Tom. I would say as a broad aggregate statement, continues to feel like live events are a central piece of what consumers want to spend their money on. We had a tough World Series comp, right? You can't really get better than the Yankees and Dodgers. And so I think World Series volumes and average order size were down relative to that. But when we look at the World Series relative to every year post-COVID, other than the Yankees and Dodgers, this was the second best year. And so I think healthy, robust demand, we're seeing that across a lot of high-profile events. I think we alluded to this last quarter. To the extent we have seen softness, it's more been on the lower end of the market, and I think we actually see that manifest in Vegas more than in our core business. The call it weekday, lower AOS shows have been feeling, I think, some of this, much talked about consumer softness.
Excellent. And then I might be a little early in this one, but can you talk about your capital allocation priorities, including reinvesting in the business, international expansion, strategic M&A, and buybacks?
Yeah, I think, for now, it's reasonable to assume that we won't be looking to complete acquisitive M&A, that would be, call it adjacencies. I think we've long believed that there could be compelling consolidation in this space, and so we would be eager participants in that. But TAM expansion, I think we've got to batten the hatches and focus on the core business. Given the performance on both EBITDA and cash flow this year, I think we'll display a lot of prudence on any cash leaving the system, including share repurchases in the near term. I think we think that there's a very compelling value at these prices, but step one is batten the hatches and assure that we have all of the capital we need to continue investing in all of the initiatives that we see really compelling ROIs against, such as international. And so we'll keep doing the defend the core. And then once we have a little more of a proven track record of stabilization, return to growth, return to cash, we can open up the aperture a bit.
Thank you, Larry. Thank you, Ted.
Next question comes from the line of Andrew Mayrock with Raymond James. Your line is open.
Thanks for taking my question. Maybe on the international part there, I guess what signals are you seeing in kind of that, what you call the core international business that give you the impetus to continue investing there as opposed to maybe rationalizing some incremental cost savings out of that business? Thank you.
Yeah, thanks, Andrew. I'd start with, we've been pleasantly surprised at the quickness with which we've been able to bring the international business to be contribution margin positive. So we are there today already. I think we've had, just to refresh on the context, Viagogo has a very substantial market position in Europe. And as a result, when we have shown up in pockets where we have fully competitive supply, and I would say that has initially been areas where it's either NFL comes to Europe, U.S. artists go on global tours, or other events where U.S. sellers have meaningful positions. we immediately have fully competitive supply. When we have competed for traffic and eyeballs on those areas with competitive supply and competitive pricing, we have seen abundant success. The task ahead then is to continue to add pockets across various countries, especially with the focus on local events where we can have that fully competitive supply and pricing. And from what we've seen, the ability to market profitably will follow quickly once you have that supply in place. That's some hand-to-hand knife fighting to get to that point, and so that's the journey we're on from here.
There are no further questions at this time. That concludes today's call. Thank you all for joining. You may now disconnect.